Welcome to my channel. In today's class, we are going to discuss about some items that should be shown in the balance sheet of a company. The first item is relating to the share application money. Share application money is the amount that we should pay to the company for getting shares. Here it is given as the Schedule 6 requires share application money not exceeding the issued capital and to the extent of non-refundable shall be classified as non-current. Schedule 6 is a revised Schedule 6. It shows that it tells that the share application money not exceeding the issued capital. Issued capital is the amount or the actual value of shares, and if the share application money is not exceeding the issued capital and to the extent it's not refundable. Refundable means it's not paid back. Then that application money should be classified as non-current. It will be shown on the face of the balance sheet as in the balance sheet it is shown as share application money pending allotment. Then our next item is relating to the borrowings. Total borrowings. Borrowings is the amount that we borrow. If we have any necessity, we borrow amount, and that amount is known as borrowings. Total amount are classified as borrowings is classified as long-term borrowings and short-term borrowings and current maturities to long-term debt. Now we are moving to the details regarding these three borrowings. The first one, the loans which are repayable in more than 12 months or operating cycle. 12 months is regarding as one operating cycle of a firm. Then if the borrowed loan is repayable in more than 12 months, that should be classified as long-term borrowings on the face of balance sheet. Then our next category, there is loans repayable on demand. Loans repayable on demand or whose original tenure is not more than 12 months or operating cycle is classified as short-term borrowings on the face of the balance sheet. Then our third category is current maturities. Current maturity means currently repayable to long-term loan include the amount payable within 12 months or operating cycle under current liabilities with the note to accounts. That is, there should be a heading showing the note to accounts. Here, from here we have to specify what it is. Then deferred tax assets or liabilities. What is this deferred tax assets or liabilities? It is this item that results from the non-payment. Is item that results from the overpayment or advancement of tax. That is referred to as deferred tax assets or liabilities, and it's always shown as non-current. This is in accordance with the IAS. IAS means International Accounting Standard 1. Standards are the policies for systematic account keeping. Then tax payable. Sundry creditors have been replaced with the term tax payable. Tax payable is the other name for sundry creditors. Sundry creditors means if you purchase anything, sundry creditors amount that we have to pay to the supplier or any firm uh, for um, for buying things from them. If you have, for example, if you are buying some raw materials from the supplier on credit, that is, we are not paying money on spot. That is termed as sundry creditors or trade payables. Sundry creditors have been replaced with the term trade payables and are classified as current and non-current. Trade payables to be settled beyond 12 months from the date of balance sheet or beyond the operating cycle is classified as long-term liabilities. That is, the liability that has to be paid back for more than 12 months. And we have to show a note to account. For example, purchase of goods and services in normal course of business. The balance of trade payables are classified as current liabilities on the face of balance sheet. Long term, if it is not paid, if it is paid within 12 months, that's classified as current liabilities. Then regarding proposed dividend. Proposed dividend is the proposed by the board of directors and declared by the shareholders in the annual general meeting. That is, the board of directors agrees to pay a certain amount of profits to the shareholders. That is the proposed dividend. It's not yet paid. It is to be paid. Board of directors propose the dividend after the annual accounts for the year have been prepared. Annual general meeting of the shareholders is held after, meaning it is held in the next year. Shareholders may reduce the amount of the proposed dividend but cannot increase it, since declaration of the proposed dividend is contingent. Contingent means liability that may occur in future. That is, this amount has to be paid in future. So it is regarded as contingent liability. Proposed dividend is always shown as a contingent liability. AS 4, Accounting Standard 4, according to Accounting Standard 4, contingencies and events occurring after the balance sheet date prescribes that proposed dividend will be shown as notes to accounts. After the proposed dividend is declared by the shareholders, it becomes a liability for the company. Liability means it has to be paid by the company and accounted in the books. As a consequence, proposed dividend of the previous year will be paid by the shareholders in the current year, and this declared proposed dividend will be accounted. In this year, if it is declared, that should be paid in the next year. Proposed dividend for the current year will be relevant for the next financial year. Proposed dividend of the previous year will be accounted in the current year, and if it is declared by shareholders in the annual general meeting in the current year, it is to be paid in the next accounting year. Then regarding provisions. Provision, the amount of provision. Provision is the amount that is kept for meeting any uncertainties. The amount of provision settled within 12 months from the balance sheet date or within operating cycle period from the date of its recognition is classified as short-term provisions under the current liabilities on the face of balance sheet, and others are depicted as long-term provisions under the current liabilities on the face of balance sheet. Then fixed assets. Fixed assets are those assets that are kept for longer period of time. Fixed assets are to be treated as tangible and intangible. Then investments. Investments are classified into current and non-current categories. Investments realized, that is, if you are getting back the money from by selling the investments within 12 months, it's considered as 12 current investments under current assets. If it is taking more than 12 months, that is non-current investments. Inventories are always treated as current. Trade receivables. Trade receivables is another name for sundry debtors. That is the amount that we have to get from other parties who buy goods from us on credit. Trade receivables realized beyond 12 months from the reporting date. Operating cycles started from the date of the recognition are classified as other current assets. From they had non-current assets with a note to accounts. For example, sale of goods or services rendered in the normal course of business. Others are classified as current assets and shown the balance sheet. Then cash and cash equivalent. It is always current. That is cash and it's a current asset. amounts which qualifies cash and cash equivalents, and its cash and the cash equivalents amount should be shown under accounting standard 3. The supremacy is according to the accounting standard over schedule 3. Cash and cash equivalents are to be disclosed in according to the prescribed standard. That's all for today. Thank you.